Have you ever felt a subtle unease, a nagging suspicion that the market isn't behaving as it should? That unseen forces are at play, nudging prices, swaying sentiment, and ultimately picking your pocket. It's a valid concern because the market, for all its data and analysis, isn't always a level playing field. Market manipulation. It's a term that conjures images of shadowy figures and clandestine deals, but its impact is far more insidious, subtly eroding trust, distorting value, and leaving investors vulnerable. It's more than just numbers on a screen. It's about the psychological toll of uncertainty, the economic consequences of distorted markets, and the erosion of faith in the very system designed to create wealth. You're not here for surface-level explanations. You're here for tangible tools, for actionable insights that cut through the noise and empower you to protect your capital. That's precisely what we'll uncover. This isn't about conspiracy theories. It's about recognizing patterns, understanding motivations, and making informed decisions in a world where the invisible hand can sometimes feel a little too heavy-handed. Our purpose is simple: to equip you with 4 key indicators of market manipulation, not as passive observers, but as active protectors of your financial future. Because true investing, as Benjamin Graham wisely stated, is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Protecting your capital from manipulation is not just a defensive measure, it's an essential part of that thorough analysis, a cornerstone of intelligent investing. Are you ready to see beyond the surface? Are you ready to recognize the signs? Are you ready to protect your capital? Let's begin. The first indicator we'll explore is the unsettling phenomenon of the pump and dump echo chamber and how to decode volume anomalies. These schemes thrive on artificially inflated trading volume, creating a mirage of demand that lures unsuspecting investors. The key is to understand that manipulation leaves traces, whispers in the data, particularly in the relationship between price and volume. Think of it as volume-price divergence. When you see a price climbing rapidly, but the trading volume isn't keeping pace, that's a red flag. It suggests the rally isn't fueled by genuine investor interest, but by artificial hype, a carefully orchestrated pump designed to attract bagholders. Now, let's bust a common myth. High volume alone doesn't automatically equal manipulation. Context is everything. A legitimate news event, a breakthrough announcement, these can naturally drive volume. What we're looking for are unusual spikes, anomalies that defy logical explanation. So, how do you spot these anomalies? Dive into your trading platform and explore volume-weighted average price, or VWAP, and other volume indicators. These tools can help you visualize volume trends, identify sudden surges, and compare current volume to historical averages. Look for deviations, for patterns that don't align with the underlying fundamentals. Think of volume as the engine of a car. A smooth, steady climb in price should be accompanied by a corresponding increase in volume, the engine working in harmony. But a sudden, unexplained surge in RPMs without a corresponding increase in speed, that suggests the engine is being strained, pushed beyond its limits, or, in our case, manipulated. Are you seeing the divergence? That's your signal to proceed with extreme caution. Our second indicator takes us into the murky world of spoofing and how to spot phantom orders in the order book. Spoofing is a deceptive tactic where traders place, then swiftly cancel orders to create the illusion of either strong demand or overwhelming supply. It's a mirage designed to trick other market participants, including algorithms, into making decisions based on false information. Imagine the order book as a bustling marketplace. Legitimate buyers and sellers place their bids and offers, hoping to find a match. But a spoofer enters the fray, placing a large order, not with the intention of actually buying or selling, but simply to create a false impression. This phantom order can trigger a cascade of reactions, influencing price movements and creating artificial opportunities for the spoofer. The ethical and legal implications are clear. Spoofing undermines market integrity. It erodes trust, distorts price discovery, and gives unfair advantage to those who engage in it. It's a cancer on the market soul. So, how do you detect this deception? You need to become a student of the order book, specifically level to quotes. Look for unusually large orders that appear and disappear with astonishing speed. These aren't genuine buyers or sellers, they're ghosts in the machine, fleeting apparitions designed to manipulate. Spoofing is like a magician's misdirection. The magician creates a false impression, diverting your attention while they execute their trick. Similarly, the spoofer creates a false sense of market pressure, manipulating other traders into acting against their best interests. Don't fall for the illusion. Question everything you see in the order book. Our third indicator delves into the news catalyst trap, dissecting information asymmetry and orchestrated announcements. Manipulators often exploit the power of information, using strategically timed news releases, rumors, or even social media campaigns to sway stock prices. The goal is to create a self-fulfilling prophecy where the news itself drives the desired outcome. At the heart of this manipulation manipulation lies information asymmetry. The manipulators possess information that's not readily available to the general public, giving them a distinct advantage. They know when a positive or negative announcement is coming, and they position themselves to profit from the resulting price swing. Remember the old adage, buy the rumor, sell the news. It often works in favor of manipulators. They fuel the initial hype, attracting a wave of buyers, and then, when the actual news is released, they sell their shares at a profit, leaving unsuspecting investors holding the bag. So, how do you avoid this trap? Become a skeptical news consumer. Cross-reference information from multiple sources, analyze the credibility of each source, and, most importantly, identify potential conflicts of interest. Who is benefiting from this news? What's their agenda? Consider the cautionary tale of insert company name here, a company whose stock price was artificially inflated by a series of misleading press releases. Unsuspecting investors, lured by the hype, poured their money into the stock, only to see it plummet when the truth finally came to light. A real story, a real loss. Learn from their experience. Don't let the news be your downfall. Our fourth and final indicator focuses on the correlation breakdown anomaly. When market logic seems to take a holiday, market correlations describe how different asset classes or securities typically move in relation to each other. For example, gold might rise when the dollar falls, or certain stocks might track the performance of a specific industry sector. These relationships, while not always perfect, provide a framework for understanding market behavior. But what happens when these established correlations suddenly and inexplicably break down? That's a potential red flag, signaling either manipulation or systemic risk. A correlation breakdown is when these established relationships suddenly deviate, potentially signaling manipulation. Our brains are wired to see patterns. So, when a correlation breaks down, it's easy to dismiss it as a random fluctuation, a temporary blip. That's precisely what manipulators count on. So, how do you spot these breakdowns? You need to actively track correlations between different assets using financial analysis tools. Set alerts for significant deviations, so you're immediately notified when a relationship starts to unravel. Don't ignore the warning signs. Imagine the market as a well-rehearsed orchestra. Each instrument plays its part, contributing to a harmonious whole. But a sudden, discordant note, a jarring break in the established melody, that suggests something is amiss. It could be a manipulated instrument, a rogue player, or a conductor losing control. In the same way, a correlation breakdown is a discordant note in the market's symphony, a sign that something is fundamentally wrong. Our final indicator shines a light on the dark pool deception, unveiling hidden order flow. Dark pools are private exchanges or forums used for trading securities, derivatives, and other financial instruments. They allow institutional investors to trade large blocks of shares anonymously, away from the prying eyes of the public market. While dark pools can provide legitimate benefits, such as minimizing market impact and facilitating large trades, they can also be exploited by manipulators to hide their trading activity. By operating in the shadows, they can influence the public market without immediate detection, creating artificial price movements and misleading other investors. Now, it's important to acknowledge the counter-argument. Dark pools also provide liquidity and efficiency for large institutional trades. They allow these institutions to buy and sell large blocks of shares without significantly impacting the price, benefiting both the institution and the overall market. So, how do you navigate this murky landscape? While direct access to dark pool data is limited, you can use tools that aggregate data from various exchanges and dark pools to get a more complete picture of order flow. Look for unusual patterns, for discrepancies between the public market and dark pool activity. Perhaps the deepest wound here is the constant feeling of being out of the loop, unable to access information that could help you make better investment decisions. The feeling that the game is rigged, that the insiders always have an edge. Acknowledge that feeling, it's valid, but don't let it paralyze you. Instead, use it as fuel to become a more informed, more vigilant investor. We've journeyed through the shadows, uncovering the subtle and not so subtle tactics of market manipulation. We've armed ourselves with knowledge, transforming from passive observers into vigilant protectors of our capital. Let's recap the arsenal we've assembled. First, we learned to decode volume anomalies, recognizing the pump and dump echo chamber and the dangers of artificially inflated trading volume. Second, we peered into the order book, spotting phantom orders and the deceptive practice of spoofing. Third, we dissected information asymmetry, avoiding the news catalyst trap and the perils of orchestrated announcements. And finally, we identified correlation breakdowns, recognizing when market logic takes a holiday and established relationships unravel. But remember, this is not a one-time lesson. The market is a constantly evolving landscape, and manipulators are always devising new strategies. Continuous learning, critical thinking, and independent analysis are your greatest allies in navigating these complex waters. Don't blindly follow the herd. Question everything, challenge the consensus, and always Always do your own research. The core message of this video is simple. Knowledge is power. Informed investors are less vulnerable to manipulation. By understanding the tactics used to deceive, you can protect your capital and make more informed investment decisions. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Apply this wisdom to the realm of market manipulation. Be extra vigilant and skeptical when there's excessive hype, when market movements defy logical explanation, when everyone else is blindly jumping on the bandwagon. That's when manipulators thrive. That's when you need to be most cautious. Are you ready to embrace that vigilance? Are you ready to protect your capital? The market awaits.